Good morning, ladies and gentlemen. It's my privilege to welcome you to the Czech National Bank's quarterly meeting with analysts, which is a traditional opportunity for us to present you our new staff forecast and to discuss the current and future development of the Czech economy and monetary policy with you. First, let me welcome our speakers for today. They are Governor Jiří Rusnok, Director of the Monetary Department, Petr Král.
Hello to everyone.
And Director of the Macroeconomic Forecasting Division, Karel Musel.
Good morning.
I'd like to ask you to stay muted at all times during the video conference. Hello. Unless I give you the floor. Should you wish to ask a question, please use the chat function in the lower right corner of your screen. From now on, you can send me a short message by entering the word question in the chat field. For the sake of an easier identification, please enter also your name and the name of your company in the chat field. Now, let's move to our new quarterly forecast, which will be presented today by Petr Král. Petr, you have the floor.
A quarterly macroeconomic forecast of the Czech National Bank. The structure of my presentation will be such as follows. First, I would highlight the assumptions based on which the new forecast was prepared. Then I will provide you with an in-depth insight into the story and figures of the new macroeconomic forecast. Of the baseline scenario of this forecast. Then I will provide you with a brief comparison of the new forecast with the previous one. And the last two parts of my presentation will be dedicated to two additional scenarios we prepared to address the major issues and uncertainties we faced when preparing the forecast. The current economic situation and its outlook are substantially affected by the ongoing coronavirus pandemic and the measures taken by governments around the globe within the fight against it. The baseline scenario of the forecast takes some assumptions regarding future course of the pandemic and of the reactions of the governments, and the outlook for endogenous variables are conditional on the fulfillment of these assumptions. The global economy is experiencing unprecedented decline of its economic activity this year, which is related to the ongoing coronavirus pandemic, and the same is true also for the countries of our major trading partners, which is the euro area. We expect that the euro area economy will decline by more than 7% this year, which will be followed by a renewal of GDP growth of more than 5% in 2021. Unfortunately, the expected recovery will not be enough to to close the currently very negative output gap before the end of the forecast horizon. In other words, the euro area economic activity will not return to its pre-pandemic level, not even by the end of 2022. Industrial producer prices in the effective euro area will decline this year due to the negative contribution of the energy component, but also the core component is very subdued as a result of the decline of the overall economic activity. According to the assumptions of our forecast, PPI will start rising again next year as these effects of low energy prices will fade away and the currently subdued core component will also pick up again. The ECB is maintaining a very accommodative monetary policy using its statutory nominal interest rates being significantly in a negative territory, combined with the extensive asset purchasing programs. That's why the shadow interest rate, which is representing the effects of this accommodative unconventional monetary policy of the ECB, lies very deeply below the statutory nominal interest rates in a very negative territory. And we expect that the ECB, as a reaction to the ongoing pandemic, will even increase its asset purchasing programs in the next couple of months. And that's why the shadow nominal interest rate is going even further to negative territory. As for the assumptions on the domestic side, we can expect that the government consumption in nominal terms accelerated quite sharply in recent 2 years, and this year is not an exemption. This high nominal growth of government consumption is reflecting a rise in expenditure on materials in health and emergency services, and extraordinary compensation of employees and public servants. Besides growing government consumption, the fiscal is stabilizing the economy by a very significant positive fiscal impulse, expansionary fiscal impulse, which is being implemented primarily through substantial support of household consumption. The estimated figure for this year's fiscal impulse is plus 2 percentage points to the GDP dynamics. As major part of those supportive measures taken in response to crisis are only of a temporary nature, and major of them will terminate or will be terminated in coming quarters. The baseline scenario expects that the fiscal policy will turn into a restrictive stance next year, with the negative fiscal impulse of approximately minus 1.3 percentage points to GDP dynamics. As I mentioned at the very beginning, the forecast is strongly conditional on the assumptions regarding the coronavirus pandemic and measures taken within the fight against it. When we were preparing the baseline scenario, we were closely monitoring the domestic epidemic situation and anti-pandemic measures taken or planned to address it. That's why the adoption of a set of measures and restrictions had already been anticipated during the preparation of the forecast. Despite some of the measures were actually taken just after the closing date or cutoff date of the forecast, major of their effect had been already anticipated when before the baseline forecast was finalized. The strength of the restrictiveness of the government anti-pandemic measures is being measured by so-called Stringency Index. As you can see in the upper chart, our baseline scenario assumes that the restrictive effect of the government's autumn measures and restrictions will peak during November this year, so in this month, and after peaking somewhat above the October level, it will gradually be eased before Christmas, and further easing can be expected after in 2021, after the pandemic situation will gradually normalize. But looking at the stringency index from a broader perspective, you can easily see that the forecast does not assume that we will move back to the zero. We will stay at similarly the same level as we were during last summer, when some of the most restrictive measures had been lifted. The current second wave of pandemic and restrictions taken against it are having quite substantial negative economic impacts on the individual industries. The value added will be negatively affected, especially in trade and market and non-market services, in the cultural, sport and let's say entertainment activities, etc. Unlike the first wave, the manufacturing sector will not be affected during the second wave as much because of the fact that foreign demand is still quite solid, and the foreign epidemic situation is not as bad as in our country so far, and there are no disruptions in functioning of global value chains, and the borders are so far fully passable. There are no obstacles for freight cargo transportation across the border. That's why the manufacturing sector will be hit during this second wave relatively mildly. So let me now turn your attention to the actual story of the new forecast, of its baseline scenario. According to this baseline scenario, headline inflation will decrease below the upper boundary of our tolerance band, around our 2% target, at the turn of this year and next year, partly to the deceleration of administered price growth, which will be a reaction to a moderation of the price growth of electricity for households. And we can also expect a slowdown in growth of food prices. At the beginning of next year, the inflation will continue to decline as the adverse effects of the coronavirus pandemic will materialize. Those will be accompanied or coupled with the effects of the exchange rate appreciation, which is expected in our forecast. And this will lead to the fact that the core inflation, which has been so far the major driver of the inflation being above the target, will be driving the headline inflation back to the target from above during next year. So at the monetary policy horizon, which is turn of 2021 and 2022, inflation will come close to the target and will stabilize there for the rest of the forecast horizon. Monetary policy relevant inflation, as you can see from the lower chart, will be virtually the same as the headline inflation, as the primary effects of indirect exchanges have been only marginal in recent months, and they will completely disappear in the months to come. As for the individual components of the overall price growth, we can expect that core inflation will remain elevated until the end of this year, reflecting only gradual fading of strong demand pressures connected with the until recently very tightened labor market. Core inflation will start to moderate significantly only as from the beginning of next year, due to mainly the expected negative demand side and anti-inflationary effects of this second wave of the pandemic. We can also expect some slowing down of the food price growth following the import prices and lower domestic demand pressures. But there will be also, similarly as in the first wave, some pro-inflationary curbing factors stemming from the fact that some transportation and production costs in the agricultural sector might be elevated due to the pandemic situation. As I already mentioned, administered price growth will decelerate quite significantly already before the end of this year as a response to the deceleration of the growth of electricity and the natural gas for households is expected to decline also. Fuel prices, which have been in a negative territory in terms of its year-on-year changes as a reflection of the previous collapse of crude oil prices, will gradually moderate their decline and will turn slightly positive in the next 2 years. As for the more detailed decomposition of the overall inflationary pressures, I would like to turn your attention to this graph. Here you can see the expected developments of the costs in consumer sector. The forecast expects that growth in total costs will pick up temporarily due to the pronounced weakening of the exchange rate we've experienced in recent months. And this effect is reflected by very positive effect of the core import price component, as you can see from these red bars. The previous quite negative anti-inflationary contribution of energy import prices, which is embodied by these gray bars, will fade out following the increase of world crude oil price. The contribution of the domestic economy to the evolution of the overall cost growth will decrease significantly in the coming quarters, owing first to the negative demand side effects of the second wave of the pandemic. Next year, the contribution of the domestic economy will increase again due to gradual recovery of domestic economic activity. As you can see from the blue bars, the contribution of price convergence will be almost constant over the whole forecast horizon. As for the domestic costs, we can expect that those will decline temporarily at the end of this year, as showed by the yellow line. This will be a response to the renewal of the decline in price of capital, reflecting the second wave of the pandemic and its negative demand side and anti-inflationary effects. The second wave will have simultaneously negative effect on the labor efficiency. That's why the contribution of labor efficiency, which are the blue bars, will turn temporarily positive, but to a much lesser magnitude compared to the spring first wave of the pandemic. The fundamental wages almost stopped growing in these quarters as a reflection of the gradual cooling of the labor market. Domestic costs will decline temporarily. This is the story for now, and as for the outlook, we can expect that the fundamental wage growth will gradually renew after the second wave of pandemic will gradually fade away, and simultaneously the contribution of price of capital will also move to a standard positive territory and will be gradually increasing. We can also expect, with the fading out of the second wave of the pandemic, that the productivity gains will be getting their standard anti-inflationary stance. On the longer part of the horizon, cost growth in intermediate goods sector will stabilize close to its equilibrium level. The labor market had been already affected by the first wave of the pandemic, and its cooling will accelerate following the second wave of the pandemic. We can expect that the total employment will further decline, and its pace of the decline will even accelerate somewhat. The unemployment rate, which already grew somewhat in the spring and summer months, and its increase was to a large extent dampened by the support from the government to support employment in individual industries. Those effects will be present even for the future, but the second wave of the pandemic will be the primary driver of the future developments. That's why we can expect that unemployment rate will grow to almost 5% during 2021 and then stabilize somewhere above 4% in the rest of the forecast horizon. Wage growth in market sector will be lower in coming quarters compared to the previous years. If we look at the fundamental wage growth, which is adjusted by so-called statistical effects, we can expect that the trough of the decline will be reached somewhere during the first half of next year, and after the economy will start getting on a better footing after the pandemic subsides, the nominal wage growth could be expected to accelerate again somewhat in the rest of the forecast horizon. As for the GDP story, the Czech domestic economic activity is negatively influenced by the first and second coronavirus pandemic wave during this year. We can expect that the drop of domestic economic activity will reach more than 7% in 2020 in this year due to the fall of all GDP components except government consumption. Negative impact of the second wave of the pandemic will fade away according to the assumptions of the baseline scenario in mid-2021, and domestic economy will return to growth, but the growth will be relatively moderate as the effects of the autumn second wave of pandemic will be felt still until the end of first half of next year. That's why the overall GDP growth in 2021 will not reach 2%, and some significant acceleration of GDP growth to more than 4% can be expected only in 2022. However, the Czech economy will not reach its pre-pandemic level before the end of 2022. As for the individual demand components of GDP, we can see that household consumption will drop this year as a result of the pandemic and of a further cooling of the labor market. Household consumption will reach its pre-coronavirus pandemic level, pre-coronavirus level in 2022, sorry. Which will be partly a reflection of the fiscal support by the fiscal impulse, which is expected to be let's say, dampening this year's decline in consumption, in household consumption. Private investment activity will be also very negatively affected by the impact of the pandemic and the repeated decline of the business confidence. Here you can see the subdued developments will continue for some longer time compared to the household consumption, because the confidence is really shaken, and private companies will be not keen on investing very much in these uncertain times. Exports of goods and services will also drop very sharply this year, but they will recover quite fast. in next 2 years, as the foreign demand situation is predicted not to be as bad as one might fear, and the functionality of the global value chains, which is assumed in the baseline scenario, will promote the performance of Czech exporting companies. Import growth will reflect the above mentioned story on domestic demand components and on export side. The koruna depreciated during September and October after the sentiment has changed following the worsening situation in the sphere of coronavirus pandemic. The short-term or near-term forecast for the exchange rate is set at 27.2 korunas per euro for the fourth quarter of this year. Further, we can expect gradual renewal of gradual appreciation of the koruna following the expected or assumed gradual calming of the pandemic situation during the first half of next year, and this will lead to the appreciation of the currency slightly below 26 korunas per euro at the end of forecast horizon. This slight appreciation trend will be supported by some widening of the interest rate differential and by the fact that both domestic and foreign economies will be successfully recovering from the current coronavirus crisis. Consistent with the new macroeconomic forecast is a stability of market interest rates initially, followed by the gradual rise in the course of 2021. The expected fading of the negative effects of the second wave of the pandemic in the coming quarters will, together with stabilization of inflation close to the target at the monetary policy horizon, this will together allow to start gradually with normalization of our nominal interest rates, which are currently very low, and the overall monetary policy conditions are in a very accommodative stance. The interest rate path is similarly to other forecasted variables conditional on the assumptions about the course of the pandemic situation and on the anti-pandemic measures taken within the fight against the pandemic. When looking at the profile of this nominal interest rates forecasts, one has to take into account that the central bank in the forecast is forward-looking, and the interest rates in 2021 are looking at the inflation developments further ahead, 1.5 years ahead. That's why the interest rate path is anticipating inflation being close to target in 2022, 2023, when the forecast assumes that GDP will be back on its pre-pandemic level and the effects of the coronavirus pandemic will have been faded away completely. Let me now briefly compare our new forecast with the previous one. As you can see from the first chart, the headline inflation forecast is marginally lower, especially in the short term, which is the effect of the downward revision of the expected administered price developments and an effect of the slight decline in fuel price outlook. This forecast also takes into account the plan of the government not to increase further the excise duties on cigarettes. That's why we do not assume any primary effects of these excise duties changes any longer, which is also contributing to the downward revision of CPI outlook. The anti-inflationary demand side effects are having effect in the same direction. On the other hand, we can expect that the weaker currency, substantially weaker currency compared to the previous forecast, will have some upward effect on prices in the next couple of quarters, which together with some upward revision of food prices following the second wave of pandemic and the increasing production and transportation costs is curbing the downward revision of the overall headline inflation forecast. As for the outlook for domestic economic activity, we can easily see that the forecast was revised upwards for the second half of this year, following better than expected actual outcome from the second and third quarter of this year. But the second wave of pandemic negatively influencing the domestic economy at the turn of this year and next year will cause that the profile of the new forecast will decline below the previous one, and we will not reach the previously expected GDP level until the end of forecast horizon. The wage growth forecast has also been shifted somewhat below the previous one as a reflection of the second wave pandemic and its negative effects on a labor market situation. The exchange rate forecast has been revised somewhat to a weaker levels of the corona, following mainly the change of the sentiment in global financial markets regarding the outbreak of the second wave of the pandemic and the riskiness of the Czech economy in the eyes of global investors. Let me now provide you with a detailed decomposition of the interest rate forecast change. The new forecast contains slightly higher domestic nominal interest rates as from the second quarter of next year. As you can see from the chart, from the lower chart, the decomposition says that the strongly anti-inflationary impact of the second wave of the pandemic pushed towards lower domestic interest rates compared to the previous forecasts, and this effect is captured by the joint category initial state GDP and wages. On the contrary, strong inflationary effect of the initial state of the economy is curbing this impact of the second wave, because of the fact that the effects of the first wave and the strength of the recovery of the economy during the summer months was much more pronounced than we anticipated in our previous forecast. The labor market maintained in a relatively good shape. Nominal wage growth did not decelerate so sharply as we anticipated, and all these factors would normally lead to the upward revision of the interest rate outlook. But this category, the initial state, is also a part of this joint contribution called IS, GDP and wages. So all in all, the negative effect of the second wave of the pandemic will prevail. There are also some factors pushing towards higher interest rates compared to the previous forecast, such as the much weaker corona exchange rate, especially at the very beginning of the forecast horizon, somewhat more expansionary fiscal impulse in 2020, together with some effect of the foreign environment. When looking at the foreign environment contribution, we have to take into account the following story. We revised the outlook for GDP in the effective euro area downwards as from the beginning of next year. On the one hand, also the euro area went through the summer months in a somewhat better way than we anticipated, but the outlook was revised downwards as a reflection of the second wave of the pandemic. And the same is true for the PPI growth in the euro area. That's why both PPI and GDP outlook in the euro area are anti-inflationary factors, or would lead to the downward revision of the interest rate path. But simultaneously, we know that the scope for potential further monetary policy easing of the ECB is somewhat limited by various factors, and this missing further or adequate monetary policy easing is generating an underlying pressure on the domestic currency, which would, other things being equal, would have tendency to depreciate, and to tame this pressure on depreciation this pressure on depreciation means that domestic nominal interest rates must be somewhat higher compared to previous forecasts. But the change, the magnitude of the change of the new forecast compared to the previous one is relatively mild, especially if we take into account the huge uncertainties within which the forecast was prepared, and within which we are living in these days and months. Let me now turn your attention to two additional scenarios we prepared during the forecasting exercise. The first one is called a worst pandemic scenario and describes the situation of potentially worse course of the second wave of the pandemic, worse beyond what had already been implemented in a quite pessimistic baseline scenario. This potentially worsening of the situation beyond the assumptions of the baseline scenario is identified as a major risk to the forecast. This worst pandemic scenario, that's why it considers major impact stronger than in the baseline scenario on the global economy in late 2020 and particularly in early 2021. The potentially worse course of the second wave would be characterized by stronger and longer-lasting anti-inflationary demand-side effects, reflecting a very deep drop in private consumption and investment following very shaken business sentiment. This scenario simultaneously takes into account negative supply-side shock in the form of disruption of the global supplies of the global value chains. And finally, the sharp decline in economic activity in abroad will only slightly be dampened by a positive effect of higher government consumption, because fiscal authorities abroad are to a large extent exhausted by their reactions to the first wave. For the domestic economy, this worst pandemic scenario assumes that the restrictive measures will be in place for a longer time and will have more negative economic impacts. I mentioned during highlighting the assumptions of the baseline scenario that we expect that domestic Stringency Index will reach its high during November and will slightly decrease before Christmas and will be further decreasing in the first and second quarter of the next year. In this worst pandemic scenario, we assume that the Stringency Index will maintain its record high level until the end of this year and only gradually decline back to the baseline scenario in the first half of next year. The domestic part of this worst pandemic scenario simultaneously assumes that the Czech government will not implement any further fiscal stabilization measures going beyond those that had already been incorporated into the baseline scenario. In this scenario, market services will be hit harder than in the baseline scenario, but what is maybe even more important, in this scenario, domestic manufacturing sector will be severely affected, similarly as in the first wave in the spring, because in this worst pandemic scenario, foreign demand is collapsing and the functioning of the global value chains is disrupted. Let's look at the concrete figures. GDP in the effective euro area in this scenario will be much lower compared to the baseline, following the assumptions of the forecast I have just described. The same is true for the PPI developments in the countries of our major trading partners, where we can expect especially more subdued growth in the core component, but the energy component is also slightly lower following the lower crude oil price expected in this worst pandemic scenario. The ECB in this scenario reacts fully to the economic situation and outlook, and it further eases monetary conditions via unspecified combination of unconventional monetary policy measures at its disposal. That's why the shadow interest rates is moving even further into the negative territory. The domestic part of this worst pandemic scenario looks like the following. The drop in external demand will be reflected mainly in more subdued domestic economic activity, which is deteriorating not only via domestic demand component, but significantly also by net export contribution and lower private investment activity. The longer-lasting and more pronounced negative effects of this worst pandemic scenario will be reflected in the more subdued development of both household consumption and worse shape of the labor market situation. Lower growth in domestic costs in an environment of temporarily highly subdued demand pressures will be reflected in the inflation outlook, which will be lower than in the baseline scenario. This scenario is consistent with the decline of the domestic nominal interest rates slightly to a negative territory, and the losing of monetary conditions will be simultaneously delivered by significant weakening of the domestic exchange rate of the exchange rate of the domestic currency against the euro, as you can see from the respective chart. The second scenario we prepared during the exercise is the fiscal scenario. In this scenario, we were quantifying the effects of possible neutral fiscal policy in 2021. As I was saying before, major part of the supportive fiscal measures taken for this year are of a temporary nature, and many of them will thus be terminated in the end of this year. This would this is making in the baseline scenario quite a strong negative fiscal impulse, and we were asking ourselves what would be the outcome of the forecast if this negative fiscal impulse for 2021 would be replaced by neutral fiscal impulse. This neutrality of fiscal policy in 2021 would mean that the government would take some additional expansionary measures on both revenue and expenditure side of public budgets, being being in their magnitude more than 2% of GDP. The list of those potential expansionary fiscal measures can be inspired by the currently discussed proposals of the government, which are being, as I mentioned, discussed in the media and in the parliament. For example, in this scenario, we introduced the abolishment of the super gross wage as a assessment base for the computation of the personal income tax, while maintaining the current personal income tax rates unchanged for 2 years. We also implemented an increase in the minimum living level and minimum subsistence level. We incorporated an increase in child allowance, continued support for the self-employed, employers and firms in selected sectors in the first half of next year, and we also had here the further cut in VAT on selected services for next year. In addition to these potential fiscal maneuver, this scenario also contains an assumption of the speedy implementation of the government investment projects that will be co-financed from the Recovery and Resilience Facility from this New Generation EU fund. Again, most of those potentially expansionary measures are in this scenario assumed to be only temporary. That's why the restrictive effect of fiscal policy in this scenario is delayed to further until 2022 or 2023. What is also important is to say that the other assumptions further assumptions in this scenario are the same as in the baseline. That's especially important for foreign economic activity and the overall pandemic situation. So only fiscal policy is changed in this fiscal scenario. Here you can see the outcomes of the scenario. The expansionary budgetary measures, meaning neutral rather than restrictive fiscal policy in 2021, will speed up the growth of household consumption and to a lesser extent also the investment activity. All in all, this will be reflected in higher GDP growth and higher GDP level for 2021 and 2022. The additional fiscal expansionary measures are contributing somewhat to the overall domestic inflation pressures, which are higher compared to the baseline scenario. Monetary policy facing these developments is reacting by somewhat higher nominal interest rates compared to the baseline, with the exchange rate being also slightly stronger compared to the baseline, helping the monetary authority to ensure that the inflation will not deviate from the inflation target on the monetary policy horizon. Having said that, I would like to thank you for your attention for now, and I am passing the floor back to our spokeswoman, Markéta Fischerová.
Thank you, Petr, for the presentation. If we can turn now to the Q&A part of our session today. As I've already said, should you wish to take part in the discussion, please let me know via the chat function. I will be inviting you to pose a question in the order in which you asked for the floor. And the first question comes from Mrs. Agata Urbanska-Giner.
Thank you. Good afternoon. Thank you very much for the presentation, especially for the second fiscal scenario, very interesting to watch. I have a couple of questions, if I may. First of all, I would like to ask about the risks to inflation forecast and focus on those demand and supply factors. How do you see the shock that we're looking at currently? Is it demand side shock, supply side shock? And what sort of experience are you, how do you judge the performance of inflation, especially through summer and those upside surprises in the context of those demand and supply side frictions? And what sort of implications does it carry for 2021? In your negative sort of scenario of extended, longer second wave of the pandemic, you also point to a negative PRIBOR. Is this what you would consider negative rates or some other instruments that would amount to the same effect? And my third question, if I may, to conclude, I want to make a reference to the comments from Governor yesterday about interest rates. And yeah, what considerations drove those comments about interest rates staying probably or possibly stable throughout 2021 against the model's implications for increases? Thank you.
Petr Král will take the first question.
I will start by the first question on the demand and supply side factors standing behind the current or recent and expected future inflation developments and the risks that may stem from that. Here in this graph, you can see the reassessment of the impact of the first wave of the pandemic on the business cycle and potential output in the euro area. The reassessment compared to the previous forecast is simply showing that according to our current estimate, the first wave of the pandemic was somewhat milder in terms of its negative demand side, standard cyclical anti-inflationary effects. And the bigger part compared to what we anticipated or to what we estimated before was, let's say, attributable to the decline in trend growth or to the potential output. The negative output gap was still widening quite significantly, but to somewhat lesser extent compared to the previous forecast or previous identification. That's why we are now even somewhat more keen on explaining the recent foreign price developments as a reflection of some stagflationary effects of this first wave of the coronavirus pandemic, and the reassessment of the euro area situation similar to ours has been done by some other international institutions such as International Monetary Fund or the ECB. So in this regard, we are moving in the same way with other colleagues from central banks and from international institutions. The story, unfortunately, is simultaneously hit by the second wave, which will be, in our view, more demand side related, because this is already second wave in a short period of time. Both households and enterprises have less cushions or less reserves to withstand this shock. The fiscal policy around the globe is also somewhat exhausted, and that's why this second wave of pandemic will have more negative demand side cyclical effects on price developments for the future, which is nicely seen from the output gap outlook. The output gap is currently somewhat less negative, but the closing of the output gap will take some more time compared to the previous forecast. And the same assessment of the initial conditions as for the euro area was made for the domestic economy. Here you can see the same graphs regarding Czech GDP and its decomposition into the output gap and potential output. Again, here the spring and summer months could be characterized as less negative output gap, with some tendency of the economy to get relatively quickly back on in a normal shape. But the second wave is changing the story, and you can see that the output gap is closing more gradually compared to the previous forecast, and the GDP level is also somewhat less compared to the previous outlook. That's why the new forecast had taken into account both the more pro-inflationary or less anti-inflationary initial state of the economy, together with a second wave of the pandemic, which will have more anti-inflationary impacts because of the fact that the sentiment is shaken. The authorities have already limited room for maneuver, and the overall uncertainty is much more significant factor. I don't whether you want this. Yeah, and as for the negative interest rate path within the worst pandemic scenario, this is a free model simulation, similarly to the spring catastrophic scenario. We do not presume any form of potential monetary policy reaction following this scenario. This is only to show to what extent monetary policy conditions would have to be eased by a combination of monetary policy tools at disposal of the central bank to react properly to this type of shock.
Yes, yes, I will join better in this second question, and I will try to address the third question. As he said, I can only confirm that these option, I mean, negative interest rates, wasn't considered seriously, at least yet. Of course, we can't exclude from our repertoire of instruments, but since the situation, at least how we are understanding and how we are able to forecast at the moment, is not need such a step from our side. There was not serious policy making discussion about that, at least yet. And we hope, I would say, that it will be not necessary even in next monetary meetings. Regarding the third question, if I understood well, it's back to my yesterday comments that the board, or let's say significant majority of the board, assess the risks of the base scenario more towards the more anti-inflationary development. We fully respect what our colleagues from staff prepared, and it's a great piece of work at the moment. At the very uncertain conditions we are doing that. But as I said, the discussion, if I can summarize the discussion of the board, was shifted a bit towards the more negative scenario regarding the general macroeconomic activity in the next quarters. So therefore, also the certain, I would say, more focus or weight on the side of a bit later renewal or start to normalizing the interest rates in in next year. But as I said, everything is under big uncertainty, so we will see, of course, the development in the next months, and we will react accordingly. That's maybe to this.
Thank you. And another question comes from Jakub Seidler from ING.
Hello, thank you very much also for presentation. Now this reply of Mr. Governor a little bit answered my question about the discrepancy about in interest rate path for board and staff, but still I would assume that the expert opinion might be a little bit stronger put into the forecast, because as there are huge uncertainty related to inflation, and then more hawkish central bank might push koruna to stronger level and basically wipe out possibility of hiking in 2021. So my question is whether the staff should not be also more conservative if there are so huge risk about inflationary pressure in 2021. This is the first question. And second one, whether you are not assuming too weak appreciation of koruna just to 26 to 3 at the end of 21, assuming 3 hikes and very benign environment of lower for longer interest rates. Thank you very much.
The whole forecast was made in an expert way, because this year is extraordinary or unprecedented situation in which we simply cannot easily use the model without strong expert judgment and inputs. That's why the forecast incorporates many judgments and many inputs to be able to and to be sure that we are not missing any important part of the macroeconomic story, which is evolving over time, and whether we are able to use the standard tools for deriving the forecast without much risk of being biased in some sort. So we discussed the scenario when it was prepared with the bank board. We took their comments on board. We discussed it within our forecasting team and sectoral experts. And as for the outcome of the forecast in terms of the interest rate outlook, one can also has to take into account that the exchange rate is still significantly undervalued compared to the expected fundamental value, which is also contributing to the overall accommodative monetary policy stance. And this is something which plays a quite important role for the small open economy, and the weakened exchange rate might even play much more important role compared to the spring, when the exporting industry was also shut down because of the pandemic, and the depreciated currency could not actually help the exporters, whereas today the borders and functioning of global value chains is undisrupted, and koruna could play its role as an automatic adjustment mechanism for small open economy facing such a huge shock. Despite some gradual start of normalization of monetary conditions, until the very end of the forecast horizon, the monetary conditions in some are in an accommodative stance. So we are just gradually withdrawing the accommodative or relaxed monetary policy stance. And as I mentioned during the presentation, the forecast is doing that in a view that in 2022 and 2023 the economy and inflation picture will be such that this would be consistent with the whole story. So the forecast, and the central bank in the forecast is forward-looking, inflation targeting central bank. The second question was to
About the appreciating koruna given free hikes, so whether it should not appreciate more.
The forecast of the exchange rate takes into account the gradually widening interest rate differential, as I was describing. This is the standard mechanism through which the exchange rate developments is described in the baseline. As I mentioned, despite this expected gradual appreciation, the koruna in the real terms will maintain its undervaluation for some time, and until recently we were kind of asking to what levels koruna could depreciate rather than appreciate. So I would not be very nervous about the appreciation tendency.
I maybe would like to add to this only one methodology remark, basically to repeat our forecast of koruna. It's our best estimate, nothing more. It's no commitment. Is basically the part of the model consideration. So that's what we should be always aware.
Thank you.
Thanks. And another question will be raised by Helena Horská from Raiffeisen Bank.
Good morning. I'm waving from Island Republic. Also would like to very much.
Helena, we can't hear you. We can't hear you properly.
Okay.
Can I read your question? Maybe?
Yeah, would be great. Thank you.
Okay.
Yes.
So Helena would like to ask whether we expect a downward revision of published Czech/GDP estimate for the third quarter of 2020.
The flash estimate of GDP is always first flavor of what was going on in the economy over the last couple of months, and there are always some potential sources of subsequent revision. During this unprecedented situation, the revision could be expected to be potentially even bigger than in normal times, but we do not want to anticipate or to preclude some revision of GDP. We believe that our colleagues from the Czech Statistical Office are doing their best to collect the macroeconomic data to track the actual developments as close as possible. That's the only way only thing I can say on that.
And Helena Horská also asked whether the Stringency Index is the Oxford Stringency Index, whether we can confirm that.
Yes, it is this Oxford Stringency Index. The whole name is quite long. We will have some box in our inflation report dedicated to this Stringency Index and its use within the forecast exercise, and there is a footnote referring to the actual source of this Stringency Index from this Oxford University.
Okay, thanks. And now I'm giving the floor to Jaromír Šindel from Citibank.
Thank you. Good morning to everyone. I would like to ask you 3 questions, if I may. The first one is how do you read the last ECB meeting, and what is the message for your baseline or alternative scenario from that? The second question would be if you may try to make something like a synthesis of your 2 alternative scenario or different scenarios, worst pandemic scenario and large fiscal impulse scenario, because I would assume that if the situation really worsens, we are likely to see larger fiscal impulses. So if you may try to make some synthesis of both scenarios. And the third question is the reaction what Helena Horská asked. do you think about publication of the inflation report, of later publication of inflation report, to include the flash estimate of the GDP in the new inflation report, not in the next one? Thank you very much.
As for the assumption on the future ECB policy, we have been closely monitoring the communication and other outcomes from our colleagues from Frankfurt. Following the worsening of the pandemic situation around the globe and in the Euro area as well, we expect that ECB will increase the volume of their asset purchases on the December monetary policy meeting. This can have a form not only via the increased volume of pandemic emergency purchase program, but also via the increased volumes of standard asset purchasing program. That's why in the baseline the shadow rate is going even further to a negative territory, but to a limited extent, because we know that the scope is not unlimited. Whereas in the worst pandemic scenario, we do not bind ourselves to this limited scope, and the scenario is showing the optimal reaction of the ECB from the model point of view, which would help to bring inflation back to the ECB's target. So this is in this regard, for the baseline, we were trying to be as forward-looking as possible, including the expected steps taken from the European Central Bank. As for the potential combination of the both additional scenarios, it is possible to do so for the sake of simplicity and for the sake of let's say clarity. We separated the scenarios to show you how the monetary policy reaction looks standing behind these simulations looks like. But you can easily combine these scenarios if you consider that both scenarios could realize materialize simultaneously. The model is linear, so from this point of view, those lines are to mechanically sum up. But this is a mechanic exercise. So as I mentioned, to show you how the reaction function looks like, we voted for that separated way of preparing these forecasts. Karel would like to add something.
Just let me add here one warning. When you combine these two scenarios together, please be careful about the fact that these two scenarios are independent. And we were not thinking that the fiscal scenario assumption of having zero fiscal impulse in the next year is consistent with the development of the worst second wave of the pandemic. So it means that when you combine that, think whether the response of the fiscal policy to this worst scenario is really consistent with the neutral fiscal stance next year.
And for the third question, the cutoff date of the forecast was October 21st. So the flash estimate of GDP that was released last Friday was not incorporated into the forecast. We just are mentioning in the inflation report that the flash estimate of GDP is the figure which was published by the statistical office. We still do not know the decomposition or the breakdown on the demand and supply side of this flash estimate, which is the standard feature of that. That's why we did not work with that further when finalizing the forecast.
Another participant asking for the floor is Jose Cerveira from JP Morgan.
Hi, sorry. I have a question for Petr Král first. So my question is, looking at the numbers that were published with the complete forecast, I infer that you have around 1% Q-on-Q contraction in the fourth quarter of this year. This would look like a very good outcome for me. So I'm curious to know whether when you closed the forecast and with the information you had back then, do you still feel comfortable with how things moved since then? And not just in the Czech Republic, but also across Europe, a number of countries have introduced new restrictions and so forth. So I was wondering if you feel that, let's say, the situation today is worse than what you had back then, and hence there are some downside risks. And then I would have a question for the governor. It seems from the outcome of yesterday's delivery that there is a bit of divergence between the forecast and how the board sees it, like was mentioned in previous questions. So my question is, in the last CNB decision, there was a couple of members who judged that there could be increased risks of easier policy being needed if the situation with COVID escalated. Now, since then, the situation with COVID more than escalated, right? It got to a level that nobody even imagined. So I was wondering if there was some divergence within the board this time around, and whether some people argued for risks of easier policy being necessary in the next quarter. Thank you.
When the forecast was finalized, the Stringency Index for the Czech Republic was somewhat below what the baseline scenario assumes for the rest of the autumn and for the rest of this year. You can see it from this graph. So the measures taken by the government on October 21st were fully anticipated. In the terms of their potential influence on gross value added and trade volumes in respective industries. And this was because of the fact that we had anticipated some further tightening of anti-pandemic measures during October and November following the epidemic situation in the Czech Republic. And looking at the lower chart, you can see how we computed the effects of the stringency and restrictiveness of social and economic measures taken by the government on individual industries, following the experience we had during the spring wave, when we had the similar approach, and when the actual outcome was very nicely close to our estimate or to our forecast. So we were replicating this approach using also input-output tables and similar things. As I mentioned, we know that the manufacturing sector is still going doing pretty well, and some of those measures have only limited macroeconomic impacts because of the fact that there is, for example, a very high import content of certain goods, which is purchased by Czech households in some retail chains, etc. So this part of the story is, I would say, robust, and Karel could add something later on. And for the external side of the story, we applied the same approach. We were trying to anticipate the future development of the pandemic situation in the countries of our major trading partner, especially in the big five countries like Germany, Slovakia, France, Spain, and Italy. And we were anticipating to what extent the potentially approved measures against the pandemic could influence the demand for our export. And hopefully, fortunately, Germany, which is our major trading partner, is going relatively very well in terms of fighting against pandemic and in terms of its domestic economic situation. That's why we believe that manufacturing sector via export channel will be influenced relatively mildly during this second wave pandemic.
Okay, so maybe to the second question. I will basically start where Peter just stopped. So we based our discussion yesterday, of course, on this new forecast. This new forecast is showing us that situation, despite, of course, big uncertainty, looks a bit better regarding this year and regarding the short past. As regards the future, we see a lot of risk, of course, on anti-inflationary side. On one hand, on the other hand, there are certain positives. Just mentioned Germany global value chains functioning, still fully passable borders. So altogether, it gives us the picture which we see in this forecast, and based on it, I would say there was very little discussion amongst the members or debate amongst the members regarding potential need to use the unconventional measures in the near future. So what I would stress is we have still in mind, if necessary, because we can't exclude that scenario for the future, but so far looks that it will be not necessary. By the way, the inflation expectations and pressures are, I would say, viably encouraged in the Czech environment. So this discussion was not present at the last meeting of the board, but we are still in process of considering, I would say rather, what to do if necessary. We will have another meetings, extra special meetings of the boards, more about, let's say, technical details and specifics of our situation in these regards, somewhere in January, if I'm not wrong. So no, I would say urgency debate on this meeting at the moment, definitely.
Thank you.
Thank you, and I would like just to check with Jaromír Šindel that all his questions were answered, or just asking whether he has enough some follow-up questions. I wasn't sure.
No, fine, thank you.
Okay. Well, it seems there are no more questions in the pipeline, so I'm asking whether there are any other points someone would like to make, comments, questions. Yes. So another one comes from Tomáš Pavelka from the Prague University of Economics.
Yeah, thank you very much. So in your alternative scenario, fiscal scenario, you calculated with cancellation of super gross wage. Probably you, or if I remember well, use there 15%. So the prime minister's probably the version. And still, there is no so big effect on GDP. Or my question is, can you tell us what's the effect of this of this measure to consumption in your alternative scenario. And of course, if you got some estimates to inflation, to the effect of this cancellation to inflation, a little more detail. Thank you.
The part of the fiscal scenario related to the potential abolishment of the super gross wage is maintaining the current personal income tax, which is 15% for 2 years. So this is just abolition of the assessment base for the computation of the personal income tax, with no change in the statutory personal income tax rates compared to the status quo. So from this point of view, we had incorporated the estimated impact of this fiscal maneuver of approximately 85 or 90 billion crowns, which is making probably the major contribution to that more expansionary fiscal policy stance in this scenario. But there are also some more measures listed in this slide. And as for the outcome of the economy, this can easily be seen in these graphs. The GDP growth is making some more pro-inflationary environment in the economy, to which the monetary authority has to react to stabilize inflation close to the target, or not to let inflation going above the target very much. That's why the interest rates are higher and exchange rate is stronger, which is simultaneously somewhat curbing the pro-growth effect of such a expansionary fiscal policy maneuver. The household consumption is reacting by being above the baseline scenario. Very majority of the disposable income is spent by the Czech households in this scenario. Karla, would you like to add something?
Just as Peter mentioned, really the fiscal impulse is considered to impact mainly the household consumption, partly also the private investment, and generating the inflationary pressures in the economy. Yeah.
Thank you. And as it seems, there are really no more questions in the pipeline. I'm closing this session by expressing thanks to all our speakers, and also to you who have been participating or watching us today. Take care and see you in February.
Yes, good luck.
Stay healthy.
Bye-bye.